Hello, and I hope you are following the whole series. In this series, we'll tie the loose ends, the things we haven't discussed. For example, usually in indirect method of cash flow statement, we start with net profit. Net profit is the profit for the year. It is available in profit and loss account. Hence, whenever we are doing a cash flow from financing activities, we take into account all the equity and long term liabilities, and if there is a short term loan as well. So in equity we have like share capital, we have a share premium, we have retained earnings and other items. So retained earnings is the portion of the net profit which was not distributed to the owners as a dividend. So when we are preparing cash flow statement, we skip this portion since retained earning, the change in retained earning from the last year is based on two things: how much net profit did the company earn and how much dividend was paid out of it. Both are dealt in cash flow from operations. Hence, when we are looking at equity and long term liability, we skip this. Okay. Second is loss and gain on sale of asset. So if you have sold an asset on a loss, that means it will appear as an expense on your financial statement. If it's a gain, you'll show it as an other income. Both of them affect financial statements. But let's assume an example: you had an asset of 100, you sold it for 80. If you sold it for 80, there is a loss of 20, and this loss of 20 is appearing as an expense. The question is, did we pay this $20 to anyone? Since it's a loss, so it is not a loss. There was no money that came in because of this. There was no $20 that went out of the business somewhere. And the same rule follows: if there is an expense which hasn't been paid, it will be added back. The second part is, how would we deal with this $20 then? It will automatically be adjusted when we are doing cash flow from investing, since we'll be taking the whole cost, the whole accumulated depreciation, and we can always find out how much cash did we receive, how, because we have a loss or a gain on asset. So third is, what about there in equity section there is also something called revaluations. So if there is a revaluations and your assets have increased, and the reason behind them is a revaluation. So revaluation is adjustment of the amount upwards. There is no money coming in, so make sure you adjust that as well. And in some of the expenses which are non-cash basis, the example can be of depreciation expenses, amortizations, impairments. So you have to look for those as well. So the tricky part is, it's not difficult, it's just simple maths. So again, I'll come to this example. So if you have a $10 of sale and $5 of cost, and all of these transactions are in cash, you have a profit of 5 and you have a cash of $5 as well. But if I tell you that 50% of $10 was received and rest is credit, so we can convert this to cash. So we have a $5 of cash coming in because of sale, and assuming this is 100% cash, $5 went out of the business, we have $0 in cash. We can work this backward as well, as we explained. So we'll start with $5, that is the net profit. We'll add back all those expenses which haven't been paid. Since all of these have been paid, there is nothing added back, and we'll subtract the income which we didn't receive. So 50% of this $10 was credit, that is $5 of credit. Since this is the income we didn't receive, we'll subtract this, and we'll eventually reach to the same answer as the other way around. This method is known as direct method, since we started from top and we came down to profit. This is indirect method. We started with net profit and we worked our way upwards to revenue to extract how much cash did we generate. And last thing, to sum it up, in cash flow from, in a very simple scenario, when you're preparing cash flow statement, you look at income statement, profit and loss account. This is also known as statement of financial performance. and all those things that are related to statement of financial performance, that is current assets and current liabilities. One small adjustment: in current assets and current liabilities we leave out bank and cash, and that's one of the questions why we are leaving it back. Since when we started, we said okay, we are trying to reconcile how much cash we had at the start of the year and how much cash we had at the end of the year, and this represents those balances. These are the balances we are trying to reconcile. Okay, so when we are preparing cash flow from investing, we are looking at statement of financial position, that is balance sheet. And in balance sheet we are specifically looking at fixed assets. In cash flow from financing we are looking at long term liabilities and equity. And these are the five elements of accounting equation. So asset is equal to liabilities of plus equity, and we look at all of these to prepare cash flow statement. And importance of cash flow statement is it tells us about company's health, where the money is coming in, where the money is being spent. Thank you very much.